Despite ongoing political and economic uncertainty, 2019 has been a very strong period for investor returns. This has been the case because both shares and bonds have done well. In each case, they have performed as central banks around the world cut rates and demonstrate their commitment to further stimulus as required. This lower for longer interest rate theme continued into the lead up to this trade update. But what we've also seen is a renewed focus on value companies, which have been previously quite unloved, as investors move away from more expensive growth names. Overall, we think share and bond markets are generally expensive, and we don't believe that this is the time to be changing our growth versus defensive mix of assets. Indeed, we continue to hold lower growth assets than we otherwise might. But in this trade update, we have made some significant changes to where we are going to get those growth assets from. Certain assets like global listed property have run very well given the outlook for lower interest rates and indeed represent the significant risk of loss of capital in our view. Australian shares have also done well, with the index reporting approximately a 20% gain across 2019. But a number of individual holdings within the portfolios, like Newcrest and like James Hardie, have delivered returns well in excess of that. While in international shares, we have taken the opportunity to trim our investments in consumer staples, which have done well, and also global healthcare, in favour of a new allocation to the portfolio, which is global energy companies. Expected returns among global energy companies are among the most attractive of any of the sectors that we see globally, and valuations have actually improved in recent times, given heightened geopolitical uncertainty in the Middle East and ongoing concerns around global growth. Nonetheless, investors are being attractively compensated to invest in this sector, and it's very much a high-quality group of businesses that make up this index, in many cases household names, the likes of Shell, Exxon, BP, etc. Looking at bond assets now, and the outlook for lower interest rates means that longer-dated bonds are generally less attractive. With this, we have trimmed our investments in longer-dated Australian and global bonds for select portfolios, preferring instead to hold bond positions with much shorter time frame to maturity, which we think will help preserve capital better in overvalued markets. Well, as I mentioned, we think share and bond markets are generally expensive, and so there is very much the heightened risk of loss present in markets at the moment. This means as valuation-driven investors who are focused on preserving capital in overvalued markets, we must pull all of the available levers to help position our portfolios to where we can see the most attractive reward for risk. And this trade update is very much about doing that, moving away from some of those assets that have done well, that are getting increasingly expensive, and into some unloved sectors that we think are going to reward investors over the longer term. Pulling this all together, we continue to have a preference for UK, Japanese and emerging market shares, as well as consumer staples, healthcare and now energy at a sector level. For defensive assets, we continue to favour shorter dated bonds and select emerging market debt. And above all, we continue to hold cash in wait for more compelling opportunities and to buffer the portfolio from any volatility that may emerge.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.